The current trading price for Opendoor Technologies, Inc. on NASDAQ under the ticker OPEN is $8.43 per share in the after-hours session, reflecting a minimal change of minus $0.13, minus 1.52% since the market closed today, November 13, 2025, at 4:05:56 p.m. EST. This tight after-hours range comes immediately after an extremely volatile intraday session, and if you're like most investors, you're looking at the recent price jump, which saw the stock skyrocket by over 20% just a few days ago, and thinking this is purely a meme stock pump fueled by retail enthusiasm, especially considering the new CEO's very public and highly unusual war on short sellers. That's the surface narrative, the easy takeaway, but the real story, the one that should keep your attention, is that the CEO's tactical, almost combative move against shorts by announcing a massive personal stock buy and a shareholder-first warrant distribution is actually a massive calculated distraction. It's designed to engineer a short-term squeeze and drive retail trading volume via platforms like Robinhood, as they were the chosen co-streamer for the recent financial open house earnings event, effectively buying the company a crucial window of time. The true underlying reality, the part that matters for long-term health, is the radical, rapid-fire operational and technological pivot the new leadership is attempting, moving Opendoor from a capital-heavy iBuyer model to essentially a software and AI company that happens to facilitate real estate transactions. This change is far more significant and far riskier than the short-term drama suggests, and it's the only way to understand whether the recent spike has any legs beyond a technical squeeze. Most people view Opendoor as a direct play on the housing market, a company that buys homes fast, makes quick improvements, and resells them, the classic iBuying model. Their expectation is that high mortgage rates, limited inventory, and overall macroeconomic pressures on the residential real estate sector should keep open stocks suppressed. The Q3 2025 financial results seem to reinforce that narrative. Revenue of $915 million missed analyst expectations slightly, and the reported net loss of $90 million, or an adjusted loss of $0.08 per share, was wider than anticipated. This immediately led to a sharp after-hours decline of over 9%. Expectations met reality, and the stock dropped. However, the subsequent rebound, which carried the share price well past its level before the earnings miss, was engineered by a narrative shift. CEO Kaz Nejatian, just a month into his role, used the earnings call not just to report results, but to declare a complete operational and philosophical reset, stating that they are refounding Opendoor as a software and AI company. This statement, combined with the aggressive anti-short seller moves, like the public pledge to purchase $1 million in stock and the announcement of a shareholder-first dividend of tradable warrants, OpenW, OpenL, and OpenZ, which inherently complicates life for short sellers by creating new instruments and potential dilution triggers, completely flipped the script. The question for sophisticated investors who are not simply riding the retail wave on sites like Reddit or looking for quick gains on their individual brokerage account is this: is the AI and software talk real, or is it a polished veneer to buy time while the housing market remains challenging? If you look closely at the financials, the challenge for Opendoor is not just revenue volume, which declined 33.6% year over year, but the unit economics. Gross margin slipped to 7.2% from 7.6%, and the critical contribution margin narrowed to 2.2% from 3.8%. This tells us that the core business of buying, holding, and selling homes is still struggling to generate meaningful per-transaction profit in this environment. The company's inventory, both the number of homes and their value, was nearly halved year over year, which reflects a cautious and necessary contraction from previous management, but also creates the low inventory that will weigh on Q4 revenue. The CEO's stated plan is to accelerate home acquisitions by at least 35% in Q4, but critically, he asserts that this will be driven by new AI-powered pricing and decision engines, enabling the company to transact with greater speed and precision, thus improving unit economics. The expectation is that AI will solve the margin problem. The reality is that the proof is entirely in future quarters. The new management is effectively betting the company's future on the speed and accuracy of their new algorithms. If these algorithms fail to price homes better and faster than human experts, the aggressive acquisition push will lead to massive inventory losses, making the stock's recent volatility look tame. Let's talk about the institutional landscape, because that often gives us a clearer picture of smart money sentiment compared to the noise of self-investing and the volatile world of Robinhood stock trading. Looking back at Q2 2025, the picture was mixed but concerning. BlackRock Inc. removed a significant chunk of shares, over 70%, and the Vanguard Group also reduced its stake by over 20%. State Street Corporation similarly reduced its position. While this was happening, a few firms like Cube Research and Technologies Limited, Two Sigma Advisors LP, and Weiss Asset Management LP added millions of shares, suggesting a deep divide in institutional opinion. The Q3 data will be fascinating, but the current trading momentum is far more retail-driven than institutional. The colossal trading volumes are a hallmark of a short-squeeze environment, partially engineered by the warrants news. As of mid-October, the short interest was high, around 25% of the float, creating a ripe target for this kind of tactical move. The CEO's promise to totally ruin the night of a few short sellers is a direct appeal to the retail investor base, those users on investment sites or through their Fidelity accounts who have seen other high short interest stocks experience explosive growth. This strategy is reminiscent of other popular meme-like stocks, and it's a brilliant short-term tactic to boost capital and morale. However, if you are building an intelligent portfolio, whether it's through Schwab Intelligent Portfolios or a personalized setup with Fidelity Investments, you must look beyond the spectacle. The core question remains, can the software and AI pivot drive the company to the promised adjusted net income break-even by the end of 2026? For context, Opendoor's business model is simple on the surface but complex in execution. It is an e-commerce platform for residential real estate, which essentially means they use data science and software to provide instant, competitive cash offers on homes. This is the Sell to Opendoor product. They take on the risk of ownership, make light repairs, and then list the home for sale. They also have the List with Opendoor product, which is more like a traditional brokerage but with proprietary tools. The value proposition is certainty, speed, and simplicity for the seller, eliminating the stress and uncertainty of traditional closings. The margin is derived from the service charge or spread applied to the home's purchase price and the quick resale at a favorable price, minimizing holding costs. Their entire model relies on the accuracy of their automated valuation model, or AVM, and their ability to execute renovations and resales faster than the market changes. Past performance has been marked by extreme volatility, with the stock plunging as low as $0.51 earlier this year before its massive run-up. The pandemic-era housing boom masked some of the model's structural challenges, and the subsequent high interest rate environment exposed them brutally. Their current approach, Opendoor 2.0, is about going back to basics, leveraging technology to make the AVM and operational logistics ironclad, cutting fixed costs, which included a workforce reduction and eliminating reliance on high-priced consultants, and focusing relentlessly on unit economics. The future outlook presents a high-stakes scenario. The most bullish scenario rests entirely on the execution of this new AI-first strategy. If the new pricing algorithms can truly predict home prices and market velocity with unprecedented accuracy, Opendoor can scale its acquisitions rapidly, as is the plan for Q4, while simultaneously improving the contribution margin from the current low single digits to the target of 5 to 7%. If they achieve this, the operating leverage of a true technology platform will kick in, making the break-even target achievable. This would validate the software and AI company thesis and fundamentally re-rate the stock, making the recent gains seem warranted. This is the expectation the new management is setting. The opposing reality is that real estate is fundamentally local and driven by human factors that a machine learning model, no matter how advanced, may struggle to fully capture, especially in a rapidly shifting rate environment. The downside catalysts are clear. A sustained period of high mortgage rates or a sharper than expected housing downturn could lead to significant inventory write-downs. Given the low current contribution margin, the margin for error is razor thin. If the company misprices just a small percentage of its aggressively acquired new inventory, the resulting losses could quickly necessitate another capital raise, causing severe dilution to shareholders. Furthermore, the very public short squeeze tactic, while effective in the short term, may alienate long-term